Today we will know about the key financial terms which are very important to know before starting a business. Understanding these terms will not only help you manage your business effectively but also empower you to make smart financial decisions, attract investors, and ensure your business is on the path to long-term growth. You don't need to be an accountant to grasp these terms, but a basic understanding of financial language is vital for making informed, confident decisions as an entrepreneur. Before starting a business, understanding key financial terms is crucial for managing your company's finances, making informed decisions, and communicating effectively with investors, accountants, and other business professionals. Here's a list of key financial terms every entrepreneur should know. 1. Revenue. Revenue is the money generated from normal business operations, calculated as the average sales price times the number of units sold. It is the top line, or gross income, figure from which costs are subtracted to determine net income. Revenue is also known as sales on the income statement. This is the starting point for understanding how much money is flowing into your business. 2. Profit. Profit describes the financial benefit realized when revenue generated from a business activity exceeds the expenses, costs, and taxes involved in sustaining the activity in question. Profit is a measure of how much your business is actually earning after covering all costs. 3. Gross profit. Gross profit is a company's profit after deducting the costs associated with producing and selling its products or services. It's also known as sales profit or gross income. Gross profit is calculated on a company's income statement by subtracting the cost of goods sold from total revenue. It's important to note that gross profit differs from operating profit, which is calculated by subtracting operating expenses from gross profit. It shows how efficiently you are producing and selling your product before operating expenses. 4. Cost of goods sold. Cost of goods sold refers to the direct costs of producing the goods sold by a company. This amount includes the cost of the materials and labor directly used to create the good. It excludes indirect expenses, such as distribution costs and sales force costs. Understanding cost of goods sold helps you calculate gross profit and evaluate production efficiency. 5. Operating expenses. An operating expense is an expense that a business incurs through its normal business operations. Often abbreviated as OPEX, operating expenses include rent, equipment, inventory costs, marketing, payroll, insurance, and funds allocated for research and development. These expenses impact your profitability and need to be carefully managed to avoid financial strain. 6. Cash flow. Cash flow is the movement of money into and out of a company over a certain period of time. If the company's inflows of cash exceed its outflows, its net cash flow is positive. If outflows exceed inflows, it is negative. Public companies must report their cash flows on their financial statements. This information can be of great interest to investors as an indicator of a company's financial health, especially when combined with other data. Positive cash flow is essential for paying bills, salaries, and investing in business growth. Cash flow problems are a common reason businesses fail. 7. Balance sheet. The term balance sheet refers to a financial statement that reports a company's assets, liabilities, and shareholder equity at a specific point in time. Balance sheets provide the basis for computing rates of return for investors and evaluating a company's capital structure. It helps you assess the financial health of your business and understand how much it owes versus owns. 8. Assets. An asset is a resource with economic value that an individual, a company, or a country owns or controls with the expectation that it will provide a future benefit. Assets provide the resources your business needs to operate and grow. They are used to generate revenue. 9. Liabilities. A liability is something that a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits including money, goods, or services. They're recorded on the right side of the balance sheet and include loans, accounts payable, mortgages, deferred revenues, bonds, warranties, and accrued expenses. Liabilities show the amount of money your business needs to repay. Managing liabilities helps ensure the long-term financial stability of your business. 10. Equity. Equity, referred to as shareholders' equity, represents the amount of money that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debt was paid off in the case of liquidation. 11. Break-even point. A liability is something that a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. They're recorded on the right side of the balance sheet and include loans, accounts payable, mortgages, deferred revenues, bonds, warranties, and accrued expenses. Understanding your break-even point helps you set sales targets and pricing strategies. 12. Burn rate. The burn rate represents the speed at which an unprofitable company consumes its cash reserves. It's the rate at which a startup company is spending its venture capital to finance overhead before generating positive cash flow from operations. It's a measure of negative cash flow. Knowing your burn rate helps you determine how long your business can operate before it needs to generate profit or secure additional funding.